I don't want to be until 6, please.
I'd like to call the meeting to order. And Diane, would you please call the roll?
Chair.
Present.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn. Borough President Queens. Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters. Okay. Transport Workers Union.
Present.
District Council 37.
Present.
We have a quorum.
Thank you. If there are no objections, we'd like to change the order of the agenda slightly and have the PRI presentation, which is item number 4, come first. And I believe that gentleman is here.
I'll go get it. I'll go get it.
Okay.
He left copies of the presentation, okay, and I don't know if we have enough for everyone, but share. I'll go get them.
These are up to the board, not for everybody.
Oh, wait, I gotta take this.
We might have. We might have enough. We might, I don't know.
Would you like me to call? She sent this to me, she emailed it to me and said, please print and send that to the trustees. Okay.
Pretty good. Yeah. I want somebody. See, I still enjoy it. I don't enjoy the meeting around, but I actually enjoy the conferences, the arguments, but I just hate the writing.
Yeah, I don't mind the time.
Yeah.
I just have papers, notice, a whole bunch of stuff.
It's funny, I've been hit with like 5 arbitrations this week. Yeah, it's been at least a week. 5 arbitrations.
Labor?
One of my clients got started, and I'm just like being trained to some learning.
I'm pleased to introduce Rob Lake of PRI, Principles for Responsible Investment. NYCERS is an original member of that organization that was formed in 2006, and Trustee Al Rodriguez and Jimmy Ann and I had met earlier last year with Rob, who was new to PRI at the time, and he was new to us, and we were new to him as well. So we thought collectively that it would be an excellent idea if Rob came to NYCERS and sort of reintroduced himself or reintroduced his organization, PRI, to NYCERS. And and to that end, we had an excellent conference call a few weeks ago talking about PRI things and some of the things that they do in ways that what they do might be useful to NYCERS in terms of evaluating investments and best practices and so forth. And it was agreed that Mr. Lake would come to the February meeting of the investment committee and meet the board and give his presentation. So without further ado, I give you Mr. Lake.
Thank you very much indeed. Good morning. Would you like me to stand up, or am I okay sitting down? How do you normally work?
However you're comfortable.
I'll project. If I stop projecting, just shout and I'll stand up. Thank you for that characteristically gracious introduction, Ray. Just as we were coming in, Ray said that I was in a very lucky and privileged position because I was meeting you while you were still fresh, right at the beginning of your meeting. So I can't get away with the old joke that I'm the only thing standing between you and your lunch or you and your end of the day drinks. But you might not be meeting me at my freshest in that I just arrived from the other side of the Atlantic yesterday evening. So you might have to forgive me if there's the occasional incoherence in some of my sentences. So as Ray said, I'm with the Principles for Responsible Investment, which is now a global network of around about 1,000 investors with something in excess of $30 trillion of assets under management. In fact, we're just having a party this week in the office, which I'm missing, unfortunately, because I'm over here, to celebrate the fact that we've reached the magic 1,000 signatory, 1,000 member level. So we're very pleased about that. Launched 6 years ago now at the New York Stock Exchange, one of those events where people ring the bell and launch an interesting new program. And NYCERS, as Ray said, was one of the founder members, so we've been privileged to have NYCERS representation in our activities right from the word go. In fact, you're much longer standing within PRI than I am, at least as far as my status on the staff is concerned. I joined the staff in May last year, moved back to London. I'm from the UK, as you can probably tell from the accent. Actually, it's not me that has the accent, it's you. I'm sorry. So I moved back to the UK, to London, having been in the Netherlands for 4 years working for APG, which I'm sure you're aware is technically APG itself is not the fund, it's the manager, the management organisation that handles all the investment management and all the admin as well for ABP, which is the big Dutch public sector fund. So a bit like the equivalent for the whole of the public sector in the Netherlands to what you are here for New York City. And there I worked with a group of people, 8 of us by the time I left, on environmental, social and governance issues right across the whole portfolio there, looking at all asset classes from soup to nuts, as it were. So I was there for 4 years before that. I was with a conventional, I suppose, money manager in London called Henderson Global Investors, but with a strong socially responsible investment focus. So I've seen different parts of the investment world and the investment business. And now I have this very privileged position with PRI, being able to see what's going on all around the world and monitoring that development that's led PRI to that position of having 1,000 signatories. And it's very, very striking, actually, that there is so much very, very strong interest among some of the world's leading and largest pension plans on every continent in this mission that PRI has. So we have folks like yourselves here in the US, the largest funds here, and are very keen to develop more relationships with your colleagues over here. We have very strong representation in Europe. Very intriguingly to me, some of the large Japanese corporate pension plans are starting to become very interested and very actively involved in what we're doing. And it's an emerging markets phenomenon as well, which brings us on to what we're going to be focusing on, or some of the things we're looking at in the presentation, in that some of the largest, particularly public sector pension plans linked to governments in key emerging market countries are also PRI signatories and very actively involved in our work. So the Brazilian government pension fund, CRAVI, is a member, and their chief investment officer is on our board. The South African government pension fund also involved, their chief investment officer also on the board. The Korean National Pension Service tends to hide its light under a bushel to some extent, but it's already one of the largest pension funds in the world and growing very, very rapidly, with an asset allocation which, from the perspective of people over on this side of the world, looks very strange indeed. It's mainly fixed income and mainly invested in Korea. So they're starting to, maybe like a lot of US funds, in fact, starting to think more globally, think more internationally, thinking more about risk in that context, new kinds of risk that they need to understand. And as part of that, they're becoming involved with some of PRI's work. So PRI is a global phenomenon and a very vibrant, interesting place for me at the moment to be working. And it's a pleasure and a privilege to be able to come and talk about some of those things with you here this morning. So, as Ray said, we had a conference call a couple of weeks ago, and I was asked to concentrate, at least in the first instance, on some of those emerging market issues, because I gather you've been going through some thinking about your own policies and approaches to some of those things. So that's where I'm going to start my presentation, and then move on to a slightly broader discussion of environmental, social and governance factors right across the portfolio, across all asset classes, whether that's emerging markets or developed. So I don't know whether everybody has a copy of the presentation. Apologies if not, but good if you have. I talked about some of the headline numbers with PRI there, the 1,000 signatories and $30 trillion in assets under management. But in terms of the substance and the philosophy, what it's really all about is this paragraph which you have here on the first slide, which amounts to an investment belief. It's a bit long and wordy to be something that a self-respecting consultant would say a pension plan should have as a nice, crisp, concise investment belief, but it amounts to the same thing. So it says that as institutional investors, we have a duty to act in the best long-term interests of our beneficiaries. Statement of the obvious, but it's a very important thing to remind ourselves of and to remind the world of. In this fiduciary role, we believe that environmental, social and corporate governance issues can affect the performance of investment portfolios to varying degrees across company sectors, regions, asset classes and through time. So it's an enterprise that is set very firmly in the fiduciary context. We're not talking about wantonly going out and trying to lose money by being excessively socially responsible. But we recognise that applying these principles by having that focus on environmental, social and governance issues may better align investors with the broader objectives of society. So we know that the people in the world around us, beneficiaries and others, care about these things as a matter of their own values, as it were, but precisely because people care about these things so much, they sometimes can become very financially significant. They can have an impact on corporations through the way that consumers make decisions, through the way that governments regulate in response to those public concerns, and so forth. So we're looking at if you imagine a Venn diagram, I have a slide I sometimes use but didn't include here, you have two ovals intersecting. One of the ovals is long-term fiduciary interests, which are first and foremost financial. The other is the long-term interests of society, which is a slightly broader concept, not exclusively financial. We're looking at the area where those two intersect here, where the environmental, social and governance factors become financial and need to be addressed consistently and coherently by a long-term fiduciary investor. So, moving on to the next slide, it's about... Now, I started my career many years ago as a translator. That was involving multiple languages. I was translating from French and German and Spanish into English. Subsequently discovered, since I've spent more time in the last 10 years or so speaking to people on this side of the Atlantic and talking about some of these issues we're looking at today, that you need to be a translator to communicate between the UK and the US. And there are certain words which can very, very easily get us into very hot water indeed, and sustainability is one of those words, unfortunately. What I mean by the word sustainability in this context, in the heading to this slide here, long-term sustainability from the perspective of a pension plan, is that the pension plan itself needs to exist, quite literally needs to exist for a very long period to do what it exists to do, to make investments and pay pensions to those millions of beneficiaries. In order to do that, to generate those long-term sustained investment returns, it needs to be interested in a whole range of long-term issues which are going to affect investment returns over time. And a long-term investor with that perspective in this day and age is going to find itself more than likely being interested to a greater extent than very short-term investors in issues like climate change or human rights or corporate governance. If you're in and out, if you're a very, very short-term trader turning over your portfolio very, very rapidly, you hold a security for 3.2 nanoseconds, and you're just investing in blips on a screen rather than taking an interest in the long-term health and prosperity of the underlying assets, then you're going to have a different view. But for a long-term fiduciary investor like NYCERS, you're likely to be more interested than many other investors in these long-term issues that are closely linked, as I was saying before, to some of those things that people label environmental or social and to do with corporate governance. And as the financial crisis has shown very, very clearly, we all depend on a healthy, functioning, long-term financial system. And if the system itself is plagued by repeated short-term crises, that is not very good for the long-term health of a pension plan like yours or your colleagues around the world. So that long-term sustainability, something which is sustained in the long term, sustainability of the financial system itself, is clearly directly in the interest of an institution like NYCERS. So sustainability in that broad sense, not uniquely environmental. So that's, as it were, the broad philosophical background, if you like. Then moving on to specifically emerging market or country-related risk issues, which I was asked to focus on, where I gather you've been thinking about your own approach. Now, clearly there are... One of the interesting things for me in this job that I have, but equally it's a frustration, is that there's no such thing as the right answer. That's either really frustrating or it's great because it's intellectually stimulating and it keeps me in a job. It's not black and white, it's about shades of grey. It's about, like a lot of things with pension funds, I guess, it's about process, due process, having the right kinds of information available to make an informed decision so that the course that you conclude you want to steer is one that's fully in line with your own policies and principles and objectives, rather than there being some great tablet of stone that can come down out of the sky and say this is precisely what you should be doing, this is the only way to do it. And so this question of country-related risks and issues is a very good example of that, and pension plans and other investors around the world approach it in very different ways. So one of the classic ways, which as I understand it is the way that you've thought about it hitherto, is that you simply say there are certain countries which are completely off limits. So the unit of analysis, as it were, is a country, and you try to work out whether things going on in a particular country are acceptable or unacceptable according to some sort of standard. Then you obviously have to think about where you get that standard from, and you think about your own policies and values and principles as a board and as an institution, and then you test entire countries against that yardstick on the basis of research which can come from various different places. There are specialist research providers, obviously, who do this. That is complex in practice, simple in theory, if you have a way of getting hold of a list of countries. Thinking about the concept of an unacceptable country is in principle a straightforward thing to do. The disadvantage from an investment perspective, theoretically, and this has really been demonstrated just recently in practice, is that screening out a bunch of countries from your portfolio doesn't insulate you from some of the worst risks that might arise or be generated within certain countries. So risks either financially or in terms of a broader notion of social responsibility or perceptions by beneficiaries of what it is appropriate for the institution to be doing. So you can decide not to invest in China or the Philippines or Vietnam or wherever it might be. So well, I was going to say you don't have a cent invested in those countries. In practice you do, but by indirect routes. But superficially it looks to the outside world as though you don't have a cent invested in those countries. Then it turns out that corporations in which you're investing tens or hundreds of millions of dollars very close to home are themselves very deeply enmeshed with what is going on in those countries through global supply chains, and the issues come back to bite them and you as an investor by that indirect route. So Apple and Foxconn in China, Honghai, Taiwanese company actually rather than mainland Chinese. So you can decide not to invest in Taiwan or not to invest in China, so you wouldn't, looking down the portfolio, you would not see the name of the offending company on your list of investments, but by virtue of your, I assume certainly tens, maybe hundreds of millions of dollars of investment in Apple, you are exposed to that issue because Apple is buying iPads and iPhones and all the rest of it from that contract manufacturer with high levels of suicide in the workforce, which are a financial issue both for that Taiwanese company itself and for Apple because of the consumer response, and a broader matter of social concern and perhaps social responsibility. So simply taking out countries from the portfolio achieves certain objectives but not others. But then the question is, what are your objectives? That's something which somebody like me coming from outside is in no position, just not appropriate to dictate, but the point is to think through what the objectives are and to assess what how successful or effective different policy approaches would be in achieving those objectives. So you can take out countries, or another approach that many funds take, not so much in the US I think as in Europe in particular, is to adopt a body of minimum standards on environmental and social and corporate governance issues across the whole of the portfolio, regardless of country, in principle. So you can say, we have an expectation that every company or asset that we invest in our portfolio should operate in accordance with a body of minimum standards of some kind. Then the question, of course, is where do you get those standards from? Do you think it's appropriate for you as an institution and your board responsible for the institution to make up your own standards? Or do you think that there's another institution somewhere that's better placed to do that job of determining what the appropriate standards are, and how do you judge what an appropriate institution is that could determine what those standards might be? Now the way, and incidentally, I moved from London to the Netherlands in February 2007. Arrived in a foreign country, not knowing very much about how pension funds there worked, let alone the rest of the country. 6 weeks after I joined the staff at APG, there was a prime-time television documentary one Sunday evening spotlighting the fact that all the largest Dutch pension funds at that time were still invested in companies that make cluster bombs and anti-personnel landmines. And it's not illegal. It is illegal under certain circumstances if the government in which the company concerned is located has ratified the relevant international agreement, it is illegal to make cluster bombs. It's not illegal to, even in those circumstances, it's not illegal to invest in companies that make cluster bombs. So what the Dutch pension plans were doing was completely defensible legally, but it was a massive, massive, massive issue in terms of public opinion and beneficiary backlash and so forth for the Dutch pension funds. So I had something of a baptism of fire within my first couple of months at APG on precisely this issue of where you get, if you come to the conclusion that you need some sort of guiding framework for your investments, embracing these environmental and social and corporate governance issues, where does that framework come from? You can't just, well, you could, but it would be tough to run a large investment institution on the basis of the headlines of the day. Oh, there's another one, we'll just adopt a policy and take another whole sector or another whole load of companies out of the portfolio, and then next week it's another one, and the week after that. You know, that's just no way to run an institution. So clearly you need a bit more clarity and stability. Where does that come from? The way APG did it, and a number of other large continental European funds have done it, is to take United Nations standards as that framework, to say the United Nations has some legitimacy, 100 and some governments around the world, whatever it is, have decided that this is a body of minimum standards on issues like child labour and certain levels of environmental protection, and we acknowledge that that's an appropriate framework, and we then work out a way to bring that into our portfolio. The question then is how you do that. Again, there are multiple ways. Having decided that that might be an appropriate framework, there would be different ways of operationalizing it. I've lost track now of whether I'm still with my presentation here. Here we are, minimum standards applying to all investments. So you could simply say, though it would be very difficult, here are my minimum standards that I have judged to be legitimate and authoritative, United Nations or whatever, international agreements acknowledged and ratified by the US, some suitable way of reaching that judgment. And I'm simply not going to invest in any company or any kind of asset that doesn't meet those minimum standards. Number one, how do you know whether they meet those standards? And number two is simply ejecting them from the portfolio if they're already in, or deciding not to go into them in the first place, an appropriate, prudent approach. So to deal with that, a number of these large European funds have said that these are the standards which we expect, but that if we find, on the basis of our own research and research which we combine from credible external parties, that there are companies that are not currently operating in accordance with those standards, our first step will be to go and talk to them, to find out what's going on, to see if we can utilise our position as a shareholder to exercise some influence. So clearly that concept is something that's not at all new and unfamiliar to an institution like NYCERS. You've been doing things like that for many years in your corporate governance programs. The difference might be the framework and the way that you think about priorities and targets and so forth. So you might have this framework of policies based on international standards, and then say that actually, given who we are in the world, given the fact that in a position as such a large investor, we have the capability to be a force for good, to exercise positive influence over companies. Plus, ultimately, of course, we're talking about fiduciary responsibilities, and we have to be careful about just how much we eject from the portfolio for financial reasons. And if you can find a win-win between discharging the financial responsibilities and exercising positive influence as an investor to bring about change in those companies, then that's a strong position to be in.
So in this scenario that you're talking about here, is it fair to say that there really are multiple approaches that these funds might be taken? Some might be screening of individual companies themselves. Some may be, as you say, the positive proxy approach. The other may be delegating responsibility to investment managers to adhere to standards.
The funds that I'm talking about here, so the large Dutch funds, Scandinavian, French, Northern European broadly, not so much UK, have a very carefully demarcated category of companies that they will never invest in under any circumstances, based in most cases on weapons that are either prohibited or judged to be morally objectionable, let's say. I mean, the precise terminology is a little bit of a minefield, if you'll forgive the expression, in itself. So, as I was saying before, there are weapons that some people consider to be morally objectionable, which are not illegal. But that's precisely the kind of judgment you have to make on the basis of your own fiduciary responsibility towards your beneficiaries and so forth. So where do you draw that line? APG, where I worked, was repeatedly criticised, in fact, for having drawn its line very firmly along the same line as the law. So APG said that there were certain things that it was going to continue to invest in because they were legal, whereas some of the campaigners and a certain body of opinion among the beneficiaries was saying this is just completely repugnant and unacceptable. Now, APG, looking at the beneficiaries, I don't want to spend too much time talking about another fund, but and stop me if I'm doing exactly that. But APG has a very, very, very broad base of beneficiaries. Quite literally, its beneficiaries include the members of the Dutch military who fly planes which have, at least historically, dropped cluster bombs. At the same time, the beneficiaries include people who work in hospitals who treat the members of the Dutch military who come back having been injured in those conflicts. So how do you as a board, you have to exercise some independent professional discretion and judgment as a board in that situation, because there's no single view that you can take from your beneficiaries. So back to your question, a very, very small, very closely defined demarcated category of complete no-go around those weapons usually. Then the bulk of the portfolio is covered by these broader minimum standards on all the environmental issues and the social issues, where as I said, it's framed as an expectation in terms of the responsibility of the institution, the investing institution, but also as a recognition that companies that don't manage these things well might well find themselves in financial difficulties, like Apple, like Foxconn. So it's not purely a question of ethics and social responsibility, it's the intersection between those two. And that's one of the judgments, of course, you have to make. So if you set a framework based on United Nations standards, for example, and you say it might be headline grabbing in the wrong way to say NYCERS has decided that child labour is not good. People would assume that you think child labour is not good, but you have your policy that says that child labour is not good, international standards outlawed and so forth, and what we're now going to do is seek to exercise influence over companies if we reach the conclusion that they're not up to that minimum standard. What some of those big European funds have then done, which, as I say, is an option, it's not for everyone, but it's what they have built into the mechanism, as it were. They have said, if after an appropriate period of attempting to exercise positive, constructive shareholder influence, we reach the conclusion that we're just not achieving any objectives, then we can divest. But then whether it is appropriate or legally possible for you to do that, as to have that option in your context, is clearly entirely up to you. For those European funds, they've concluded they can, but it's not up to me to opine as to whether that's a matter that, in the fiduciary context here, whether that's possible. Simply as a matter of fact, that's what some of those big European funds have done.
Can I add something to that? We recently heard from a manager that's a signatory that they don't have a restrict list, but they judge risk associated with the company based on the principles.
Yeah.
So that there's a natural selection process that will go on because of the principles.
Yeah.
In comparing risk between companies.
Right.
And that companies with more risk, they'll invest in the company that has less risk.
Yeah. Well,
A lot of that, I assume a lot of that goes on too.
that's right. So, without going into too much of the technical detail in this context, it's important to note that the principles for responsible investors themselves are a framework for investors for thinking about these things. They don't dictate what companies should do, the companies that investors invest in. So the principles just set out a broad process framework for thinking about this stuff, on which you can hang your own policy on issues like child labour, on the environment, or corporate governance, and so forth. So if a manager says to you, yeah, well, we're fully in line with the principles for responsible investment, that doesn't in itself address that question as to how they look at risk in companies. So the next question would be, okay, so how do you judge whether a company represents too high a risk, or what kind of risk it represents? And can you talk me through some examples? What is the manager's own? Is it just that they come in on the day and because you ask the question they suddenly remember that they do this, or is it something a little bit more systematic and documented and hardwired into their process in a way that can be subjected to some scrutiny and give you some appropriate assurance? I mean, essentially this stuff, there's no reason why this should be any different in principle from the rest of your routine business, in the sense that when you're talking to a manager, you expect appropriate, and you judge what appropriate means, but you expect appropriate levels of assurance with regard to their capability and their competence on a whole range of things. And sometimes you will have feel more assurance and feel more comfort if things are documented, auditable, than if it's just something that a portfolio manager comes in and says in marketing mode on the day, as it were. So this whole area, I think, can fit into that framework. If you have your body of well-articulated expectations and standards, you can ask your money managers to make a formal commitment contractually to deliver that, or to demonstrate that they have used their best efforts to deliver that policy and that framework on your behalf. And you can ask them on a regular basis to comply or explain. To say, okay, for this period, here's the portfolio, give me some examples, tell me how you have assessed the kinds of risks that are the things that we're targeting in our policy framework over this period in the context of the portfolio. Talk me through, for example, why you were so overweight BP at the time of the Gulf of Mexico explosion. Are you sure that was the right position to have been in on mature reflection, and what are you going to do about it in the future to make sure you don't get us back into that kind of situation? Or talk me through, again, whatever it might be, that child labour situation with a company in China or whatever. Which does take us on to the question of your own information sources and resources to enable you to develop and then to execute a policy of this kind. So it's all too easy, sadly, of course, for there to be what the jargon calls an information asymmetry. In other words, the guys on the other side of the table just have more information than you do about a given issue. But there are information providers who are increasingly recognising this and responding to a commercial opportunity by being able to provide information about particular stocks, particular companies, for example, with some background briefing, and your own internal people will be able to do similar things as well, I'm sure, to say, yeah, well, this is our view on the background to BP. Actually, there was a lot of information in the market that might have led you to conclude that there was substantial risk of this kind. How come the manager wasn't aware of that? So there are people who can help you, equip you with that kind of information for your regular, or your staff's regular monitoring activities with managers to gain that assurance that they're implementing your policy in the way that you expect.
Now, the example you just gave was for an actively managed portfolio. Right. So how do your signatories handle application of the principles if portfolios are managed passively?
Well, you can apply the same policy as far as expectations are concerned and the same policy as far as exercising shareholder influence is concerned. What you can't do is take that final step. If you were to take that final step of divestment anywhere in the portfolio, then you wouldn't be able to do that in your passive portfolio. Managers would say you can't. There are people who manage to find ways to do it, but let's say you can't. So then it's a question of ongoing efforts to exercise that shareholder influence through corporate governance programs and so forth. But in principle, you can still have those standards. The framework of standards acts as the reference point for what you expect companies in the portfolio to be doing and the direction in which you want them to move as a result of your corporate governance activity. But what might differ across different parts of the portfolio is the ultimate sanction, as it were.
So the information services that you would engage, now I assume there's a lot of different scenario or processes you could use where the company is either giving the information to the manager, or it's giving the information to the fund, or it's giving the information to both of them, and then telling the manager that the company is not implementing.
Right.
How does it? What are the different ways that these information managers work with the funds?
Right. So in the context where you have an external manager, let's assume you've set your policy, you've got a clearly articulated set of standards that you want the manager to apply on your behalf. You would then, let's take the easy example where you're hiring a new manager, because starting with a greenfield site, as it were, is going to be easier than retrofitting something to an existing manager who might be resistant. So as part of that manager selection process, you would say what your standards are, and then expect that and articulate your requirement that all managers who want the business have to demonstrate how they are going to execute that policy for you. So they would, you would presumably then frame some questions in the process to require them to explain their own research capability, where they get their information from. Is that internal to them? Do they have internal resource, or do they buy that in externally? If so, who from? Are those external information sources used by the manager themselves sufficiently credible and robust and so forth? You can, as we all know from multiple different contexts and situations in life, you can have a very large amount of information available but not actually do anything with it. So the manager might say, it's fantastic, don't worry, we have an in-house team of 5 people doing this stuff, plus we spend $100,000 or more a year. Actually, $100,000 might not be very much, but we spend X dollars a year on external research that we buy in, and we've got all these fantastic data sources and spreadsheets, and everybody has 15 screens in front of them with all sorts of data flashing up on a regular basis about hotspots of child labour around the world. That's great, but do any of the portfolio managers ever actually get to see that? The people who make the investment decisions and press the buy and sell buttons, do they get to see that? How does that get incorporated into their views on individual companies? Are the people who have that responsibility for environmental and social and governance issues sitting way down the corridor somewhere in a dusty corner of the building that the portfolio managers never go to, or in another building down the street, which quite literally does happen sometimes? In other words, how does all this stuff flow into the core of the investment process? And as I was saying before, this is not intrinsically any different from the way you would think about assessing a manager in the normal course of events. You want to understand their investment process. Where do their ideas come from? How do they decide that these are the companies they're going to invest your money in? Where does that research come from? What's their people's track record? All this kind of thing. It's an additional dimension to understanding the manager's process. And many of the questions that you would want to ask are, I think, directly analogous, parallel to things that I'm sure are already included in your process, to do with the manager's capability and its track record and so forth.
So What you're describing to me sounds like a situation where a fund might want to have the equivalent of a consultant telling them what their managers are doing. Now, how common is that, and how costly is that?
You might. I'm not sure, just off the top of my head, whether anybody has that model currently in place, a consultant contracted on an ongoing basis to monitor the managers. People do use their consultants when they're hiring managers and ask the consultant to build these issues into the overall process of looking at the manager. But that's not the same as the ongoing monitoring. A number of funds have their own in-house staff doing exactly this. So back to those European funds, and as I said in my introduction, at APG we had a team of 8. Now that's at the top end of the range, obviously, but just as a reference point. But then some of the other funds have much smaller in-house teams, but some degree of in-house capability and expertise on your own staff, I think, would be pretty important. Clearly you have some of that already anyway. I can see Mike sitting at the back of the room there. Again, it's not as though a lot of this is completely new. So the model where you simply become a manager of contracts is the kind of thing that people from management consultancies come in and advise on, but you have to have some knowledge and expertise to be able to specify the terms of a contract and manage that contract to know whether the contractors are doing the right thing. So I think at some point, inevitably, you come back to the right kind of and the right level of in-house expertise.
The funds that at least that do ad hoc consultants for manager selection, do those include funds in the U.S. That you're aware of?
Yes, although I suspect I don't know the detail, to be honest.
Do you think there's some?
I think so, and I think that the whole area of the consultant community's capability in these areas is something that people are becoming more and more interested in. As funds themselves become more interested, clearly service providers have a commercial interest in developing some capability that maybe they don't currently have. And it's probably true to say that the consultant community in the US has, how can I put it, a slightly lower level of experience in these areas at the moment than some of the consultants in Europe. And the people in the US with the highest levels of experience are probably the US arms of those big international firms that have a very strong presence in Europe, rather than the more purely US focused outputs.
So you'd say it's not in Europe, it's not the norm, or it doesn't happen at all, that a fund would have a consultant watching what their managers are doing. They would either do that in-house, or they would just accept what the managers are telling them that they're doing.
European funds would certainly have managers monitoring consultants monitoring what their managers are doing.
With respect to ESG.
An element of that might be ESG, but as far as I am aware, it does not at the moment go as far as some of the ideas I was floating just now. For example, providing you with information about specific stocks that you might want to interrogate a manager on. Now, that's not to say that some, at least, of the consultants would not be capable of doing that. It's just that I'm not aware at the moment that anybody has sought to procure a service of that kind. Perhaps I should go into business doing it.
Yeah.
I don't know. To avoid, that was a joke, to avoid any accusations of conflict of interest. But it comes back to what I said right at the outset, that there are no correct, perfect answers to this. And the very fact that you are having this discussion and we are having, you've invited me to take part in the discussion with you, actually puts you right at the forefront of what's going on in this arena, which is, maybe it's a nice place to be, might be a slightly scary place to be, but thinking it through with this degree of thoroughness and diligence is undoubtedly a leadership position to be in. Certainly in the US, and even in a broader international context. So I think we've covered there some of the things on that slide headed applying ESG across the whole portfolio. By implication, most of what we've been talking about has been within listed equity. You can apply similar thinking and principles and a similar policy framework to private equity. Ultimately, when you get down through the layers, you're investing in companies that are running their businesses in certain ways, which might or might not be in accordance with these standards that you might choose to set. So the question there in the private equity context is how to, as it were, wire your standards into the chain that connects you to the underlying portfolio company through the GP and so forth. But you can, again, specify very clear standards and expectations in your investment management agreement with the GP and ask them to provide the assurance to you that when they are looking at new investments or working with existing investments, these issues are on the agenda.
One more question. When funds such as this fund here decides that it wants to incorporate PRI throughout its asset classes, has it been your experience that the funds go out and hire a consultant to help them do that, or they do it internally, or?
Again, no single model. There are consultants who would be more than happy to make you a very attractive offer from their perspective, to provide you with lots of advice about how to do this. It might be a one-off where they just write a report, they come in, interview a load of people. To be honest, they might not say very much more than what I've been saying this morning. You could pay them to hold your hands through a more comprehensive process, actually involving them in writing new policies, looking at RFPs, looking at terms and conditions in contracts and that kind of thing, if that's how you choose to do it. So again,
and setting up the so-called monitoring process.
Yeah. I mean, yes. So there would be conceivably there'd be a consultancy project you could ask someone to do, which is the initial setup. What's the policy and how does that get built into the fundamentals of the business processes, the RFPs and the manager contracts and so forth. The ongoing process of working with you, monitoring managers, is, as I said, I'm sure something that some of the consultants would love to do, might be capable of doing, but that would have to be specified quite clearly. You might choose to have that done by in-house people instead.
Do you know much about what's going on with CalPERS with respect to their PRI processes?
Well, they did indeed hire one of the well-known international consultancy firms to advise them on the broad framework. As far as I'm aware, they continued to work with that. This is Mercer, it's all in the public domain anyway, so I don't have to be quite as careful as I was thinking maybe I should be. I do know some things that are in the public domain, so I'd have to be slightly careful. So yeah, they hired Mercer to do what I've just said, to review the existing situation and to suggest some broad frameworks and approaches. The bit that's not in the public domain is, I don't know whether this might have been said publicly, but maybe they concluded that they hadn't got quite the value that they had hoped for from that contract.
Okay.
And that the next stage of implementation might need to involve other parties.
Internally. How about any other funds? Any other funds kind of like going down this road?
In the US?
In the US?
Not in exactly this way that I'm aware of. But I don't necessarily have...
I do think Connecticut is known as thought leader in this, exactly what they're doing in that.
Right. I can tell you, I'm having a very interesting week this week. I'm seeing New York State on Thursday and Connecticut on Wednesday and Maryland tomorrow. All we can conclude from that is that a lot of people are interested in talking to PRI, and I'll know by the end of the week what the content of those conversations is.
Rob, I can speak a little to the U.S. fund context. I don't think there's anyone that has a commitment like CalPERS to try and figure out how to integrate across the portfolio. The different funds have picked up pieces of the portfolio beyond just their public equity and active ownership. In North Carolina looked at their entire real estate portfolio around energy efficiency. Connecticut's looking at pieces in diversity. And so I think you see not as comprehensive efforts, but more funds without that kind of resources that CalPERS has, picking off pieces to start. But CalPERS is conceptually the most comprehensive. They're still wrestling with what implementation.
Yeah, I think that's right. Yeah, that's a good way to put it. Conceptually comprehensive. It's certainly what CalPERS is trying to do. And finding it difficult because they're not starting with a blank sheet of paper. They've been doing a lot of stuff, as you have, for many years. I think one of the headlines that has come out numerous times from their work with NYCERS is that they've identified 111 individual initiatives or policies or programs of various kinds across different highways and byways throughout the portfolio, which they're trying to bring into some sort of coherent shape now. And again, this a wider question. I was saying before that much of what we're talking about doesn't require completely new ways of working. It needs to be effective. In fact, it needs to be integrated into the regular ways that you're running the fund anyway, the regular processes of hiring and monitoring managers and so forth. My sense from what's going on at CalPERS is that the comprehensive review of PRI implementation or environmental, social and governance issues is part of a wider process of comprehensive review of the way they work more generally across the whole of the portfolio and thinking about investment strategies and organisational structures and other things as well. So that makes the task even more daunting, of course.
So I think we have about 5 more minutes. We'd like to wrap up.
Well, maybe one more thing I'd like to say is that it's been a huge privilege, really, having this opportunity to come and discuss these things with you. And as I said, the fact that you're going through this so thoroughly really does put you in a leadership position, and it's quite inspiring. The PRI goes around the world trying to persuade people that this is a good thing to be doing, and you appear to have bought into that, and you're trying to do it. You're trying to make it work in practice, and it's difficult, but you're grappling with it in a way that's very impressive. And of course, there's been that long history of NYCERS' involvement in PRI right from the beginning, from the time when Mike NYCERS was on the board here, and he was a member of the PRI board. Stepped down, of course, when he left his position here. And if at some point you decided that you wanted to field a candidate for the PRI board, we have an election cycle and so forth with representation from different people around the world. If at some point you felt the time was right to put somebody up to the PRI board, that would be very welcome from our perspective.
When is the next election cycle?
Well, we just had elections just this year, so it won't be for a couple of years yet that we have the next election. But in the meantime, there are plenty of opportunities for NYCERS at the trustee level or staff level to become even more actively involved, and Mike's very actively involved anyway in some of our programs, but more opportunities for active involvement with our work. This afternoon, I'm seeing someone who, fingers crossed, I hope is going to become PRI's full-time representative in the United States. And so we're going to be working very closely with her to try to strengthen the work we do already and develop some new programs, new relationships, try to bring in other public funds and other investors of various kinds. And I'd be very interested in further discussions with you about what part you might be able to play in that, in supporting PRI's development in the US more generally, in demonstrating that leadership position you're taking, speaking at events that we might hold, helping us to develop those relationships, setting up the programs that we're going to be trying to develop.
As part of hiring staff in the U.S. and trying to expand your activities here, are you contemplating having some kind of U.S.-based advisory board?
That is on the agenda.
Okay.
It is. It's one of the things I'm going to be discussing this afternoon with this potential candidate. Yeah.
Very good.
And if NYCERS wanted to play a part in that, that would be extremely welcome.
Thank you. Are there any additional questions for Mr. Lake? Thanks again for sharing.
Thank you. And you know where to find me.
We do.
If you need me for anything
Yeah,
else.
but it's hard to get you if we need to get you person to person.
Thank you.
So we can get there.
Thank you.
Al?
Yeah.
Is there another subcommittee meeting scheduled?
No, but we should probably do that by the
Yeah.
end of the day.
Yeah, exactly. Okay, so we'll, during the break, we'll
Yeah.
take a look at times. Okay.
I found this very interesting.
Yeah, this was very good. So I think we're back to the start of the agenda, which is the Wellington presentation. Pat, are they?
That's right, someone bring them in.
I'll bring them in, and that'll feed into the discussion on December, January, and February.
This is our usual quarterly presentation on the macro views of the economy and such, and how it feeds into our portfolio.
Okay.
Let me take the high road. It's only 11 o'clock.
Okay, sure.
Yeah, I know. It's a big problem. We got Warren Buffett talking about the four banks. We got Warren Buffett talking about the four banks. We took out $1 million in the
Yeah. I missed
So for any Larry, this is, okay, Rich, you're in my office. Okay, Rich, they want to on the phone, know about that.
Aiken, do you want to start off by doing the introductions?
Sure. Thank you for having us in today. My name is Aiken Greville. I'm from Wellington Management. We're thrilled to be a manager for NYCERS. I'm joined by my colleague Marianne Carroll, who is the Director of U.S. Macro Analysis at Wellington. Marianne and her team make recommendations on U.S. growth, inflation, other macroeconomic issues to the firm broadly, which are then incorporated into all of our portfolios, including in the mortgage-backed securities portfolio we manage on behalf of NYCERS today. So we really appreciate the opportunity to come and provide you with an update on the macroeconomic outlook for the U.S. Then I'll hand it over to Marianne.
Thank you for having us. It's a beautiful day here in New York. Nice to visit you all. You all have a handout. Why don't we start right after the blue tab 1, just with some key points. It's been a very fascinating time to be a U.S. or any economist following what's going on in the world. Incredible volatility, lots of structural problems. We've been through quite a bit, and when I look at the landscape today, I have, from my U.S. seat, I have to say that the U.S. feels a lot more stable than the rest of the world. And there was a considerable amount of talk, particularly in the fall, about whether or not the U.S. Was at risk of falling into a double-dip recession. And at the time I said I didn't think so, and I still don't think so. And I'll show you a few reasons why in the next 20 minutes or so. I think we're looking at modest growth in the U.S. of around 2% this year, and that is underpinned importantly by falling inflation. Now, if you remember last year, growth was very disappointing in the first half. And one of the reasons for that is that we had escalating commodity prices and escalating food and energy prices. And that pretty much sapped consumer purchasing power and gave us pretty crummy economic growth in the first half of the year. Another contributing factor was some events in Japan, which tragic events, which really rippled across the world and resulted in significant supply chain disruptions that cut auto production in the U.S. Significantly. Now that's in the past. Right now we have inflation rates that are coming down, and that's supportive for growth. We also have monetary policy and a Federal Reserve that is willing to support this recovery to any degree that it can. QE3 is not something that I would expect in the short run, but it certainly hasn't been taken off the table if it is deemed necessary. The last thing I think that's underpinning growth this year is an assumption of only modest fiscal restraint. There is fiscal restraint, particularly at the state and local government level, and I'm sure you can tell me more about that than I can tell you. But in the aggregate, I think we're looking at only modest fiscal restraint. We've removed some of what was scheduled and sort of kicking that can down the road, so to speak. In the short run, I think we could be looking at some bumpy data, so that uncertainties might perk up again. There were a variety of tax provisions that expired at the end of the year, the most important of which had to do with investment spending. There's an accelerated depreciation allowance, which I think pulled a significant amount of investment spending by businesses into the latter half of last year to the expense of this first quarter. And I think this morning, actually, there was a big drop in durable goods orders that was reported. And I haven't seen the details, but I was expecting that, because if you can buy a piece of machinery in December and accelerate and have 100% depreciation of that machinery, why would you wait until that incentive is expired? So I think that's temporary. So we'll be looking at short-term slowing, perhaps in the manufacturing side of the economy. But after that, I think we'll be looking at more steady 2% growth. We still have a lot of structural problems. Housing is not on a solid path of recovery, although I think I have more positive things to say about housing today than I have for 5 years. So on the margin, I think there's some things that you can say positively. And of course, the deficit. This is the federal deficit and state and local liabilities. These are things that we have to deal with as a country, and I think the states are doing the states and localities are doing a better job than the federal government, but the federal government will have its day, I think, and it's coming at us. We're only going to be looking at Europe for so long, and all eyes will, at some point, turn to the U.S. And Japan to deal with big fiscal problems. In terms of, as I said, 2% growth seems likely this year. I don't think there's a big risk to the recovery this year. There's a couple of risks that I think are more meaningful next year. One would be
the drumbeat about oil prices.
Right now.
That's not bothering you?
It's bothering me. I fully anticipate. I obviously can't predict what's going to happen in the Middle East, and the rise in oil prices is something that I was not forecasting. I am assuming, and maybe this is a bold assumption, that in an election year that we're going to do everything we can to get that price down. And the first thing that comes to mind is the Strategic Petroleum Reserve. And if we release supply from the reserve, I think we'll get some benefit on the price side. My feeling in terms of real risk is next year. We'll talk about, I have some slides that I can show you. We have $535 billion of fiscal restraint that takes effect automatically in December, unless the Congress legislates something different. And we can talk about the specifics of that. The other thing that I worry about a little bit for next year, I think inflation in the aggregate probably is lower this year than last year. But if you look around the world and you have monetary policy accelerating broadly and liquidity growth that is accelerating broadly, I think you run the risk of a commodity-driven inflation pickup next year. But that's a little bit far ahead of the game. So let's just look at a couple of charts. First chart is sort of a boring old GDP chart that only an economist would love. But the bars are the sequential quarter-to-quarter growth rates at annualized rates. In the fourth quarter of 2011, we grew at 2.8%. First quarter, I think we're going to have a much slower growth rate, as I alluded to before, of 1.2%. And then we're back to sort of 2.5-ish kind of numbers, 2.5-ish kind of numbers. Why so modest? I think there's been a tremendous amount of work done on this topic. We had a huge financial crisis, a huge housing crisis, and when you study the aftermath of similar events through history, you will find that there is a growth penalty to pay. And that growth penalty lasts for a period of time. It's not just 1 year, 2 years, 3 years. It's more like 5, 6, 7. And so that tells me that whatever you thought the trend growth rate was for the U.S. economy going forward, you have to lop off at least a percentage point, or maybe at least a half a percentage point. And I've tended to think more of a percentage point in the short run. But it's still growth. And a lot of countries around the world are experiencing weakening economies and recessions. So I think from a relative perspective, the U.S. looks good. And I think that in our portfolios, we're making that bet in terms of overweighting U.S. equities versus other developed markets. The next chart just illustrates the point that I made about inflation being a problem last year. What you're looking at here is disposable income. And the dark blue line is nominal income, and the green line is after inflation, so it's real income. And you can see that in the last year, we went from 3 to 4% real income gains to 0. So actually, it's amazing that we got the growth that we did get. Consumers tapped into some savings. There was a little bit of credit card use. But going forward, I think a modest fall in the inflation rate, coupled with job growth, which we are getting, some modest rates of wage increases, which we are getting, will provide enough cash to consumers to keep spending at a modest pace. And inflation will be much less of a tax. If we flip to page 5, this question I get a lot these days. Why won't events in Europe bring the U.S. down? Well, historically, and that's what this chart deals with, there have been times when Europe has fallen into a recession and the U.S. has gone about on its own way. I think if you flipped it around and looked at when the U.S. goes into a recession, Europe might not escape recession. But in this case, when you flip it the other way, I think you'll find that there are occasions where the U.S. can continue in recovery mode, even though the Europe...
I really apologize.
No, please, I like it.
I have to go back to what you said about rising wages.
Okay.
So rising wages translates into increased consumer spending, which translates into a better economy. Is that what you said? So the effect of raising the minimum wage on a federal level or on state levels, could you talk about that a little bit?
I don't know that that's on the board. I mean, I don't know that that's happening to a large degree at the moment. There are those that say that raising the minimum wage discourages jobs,
investment, yeah.
New jobs.
Right.
I think this is not the time that you would be talking about raising the minimum wage because the unemployment rates are so high right now. I think you can do it in a tighter labor market, but I think it's tougher in the current labor market. But going back to, I think there is a positive story to be told on wages, though. It's not great, but it's better than it has been. And that is, the unemployment rate is starting to come down. By my calculations, if we just have, steady, modest job creation every month, we'll get the unemployment rate below 8% this year.
Is that because the overall participation rate has come down?
No.
So
No.
So it is
It has come down. That's true, for a variety of reasons, which we can get into. But there is steady 150, 200,000 jobs created per month. And that's my assumption going forward. And that's enough with some modest increase in the labor force to get the unemployment rate down. Now, if we can get the unemployment rate down towards 7.5%, say, which I think we can do, maybe not this year, but next year, I think that's consistent with wage rates starting to pick up. Now, wages are growing, depending where you look, at 1.5% to 2%. This is just the wage side. This is not the benefit side, right? And I think that we can start to see some modest pickup there. And that will be very helpful if you get that in conjunction with continued employment growth. Because then you have aggregate wage and salary income that is growing at a higher rate and that can support more consumption. Does that help?
Yeah.
But at any rate, I do think that Europe is a problem. The risks from Europe are risks that you probably can't see. And they lie in the financial institutions. And I know that that the Treasury Department and Treasury Secretary Geithner and his staff have been over in Europe a lot. And I think whether or not they're that welcome, I think they have a lot of experience to share. They went through some similar stuff. And in terms of creating a stable situation, preventing bank runs, things of that sort. Europe is very risky right now, and we would not be, in developed equity portfolios, for instance, we would not be recommending Europe. But I think that as time goes on, we're seeing some real progress. I think people feel a lot better today about the outcome of the situation than they did maybe 3 months ago. It's not to say that we fixed everything and the risks are gone, but the ECB and these liquidity facilities, they're important progress. In terms of direct exposure to Europe, the next page, on page 6, looks at U.S. exports to Europe. They're just not as big as they used to be. So back in back in the early 90s, at one point, exports to the European Union were 27% of all U.S. exports. It's a big number. Today, that number is 18%. So U.S. exports are much more diversified today. So a direct hit from a recession to Europe is less. The other thing that's, I think, very important is that the policy backdrop in Europe is very different than it is here. First of all, they're going through major fiscal contraction in the southern countries. We are not. We have sort of kicked that can, I think appropriately so, because the economy is not strong enough to withstand major fiscal contraction. But more importantly, on the monetary side, the U.S. couldn't look any different than Europe, and you can see that on page 7. That blue line, the dark blue line, is U.S. money supply growth, 10%. These guys are serious, and that's a pretty heady rate of growth in money supply. Europe, 2%. This is concerning. This is very concerning from the economic point of view. They need to get their money supply, they need to expand their monetary base and get their money supply growing, because this represents deflationary risk in Europe. You may say, well, doesn't that mean there's inflationary risk in the U.S.? And that's exactly what the Fed wants, a little bit of inflation. Not a lot, but a little. So I wanted to talk about some of the structural issues and maybe put a more positive spin on some of this. I think when you turn on CNBC or Bloomberg or what have you, there's a lot of negative spin to the data. There's a lot of negative spin, and it's almost as if we've made no progress at all coming out of this major financial and economic recession that we had. And I think that's just misleading. If you look at page 8, so this is the big problem. This is our over-leverage. This is household debt to disposable income. So from 2000 to 2007, we took that ratio from 90% to 130%. That was too much, obviously. And it was all the housing bubble, pretty much. 75% of outstanding consumer debt or household debt is mortgage debt. So that's where the big increase was, and we started to unwind it. Now, I actually expect that this line is going to come all the way back to where we were in 2000 and 2001, but it's going to happen extremely slowly. And it doesn't mean that we're not going to have growth. Part of this is going to happen naturally as older baby boomers are paying down the principal on their mortgages. But this is something that happens, again, very, very slowly. But
Isn't a lot of that debt illusory, though? I mean, it's debt that's never going to get paid.
Some of it, but I think we've written off a good chunk of the stuff that's. I mean, part of that's already reflected in the decline we've had.
Right.
But the great part of household debt will be repaid, mortgage debt. But you're right. Part of this decline does represent foreclosures and charge-offs. But another part of it just represents the fact that there's been no growth in mortgages, and there's probably going to be very little growth in mortgages, at least relative to its recent history, for a while. But one of the things that people miss when we talk about household debt is that there has been a major improvement in the ability of households to service their debt. And if you look at the chart on page 9, this looks at the amount that comes out of a person's paycheck each month to service their mortgage debt and their installment debt. And we peaked at 14%, and we're down to 11%. That's pretty impressive.
Is that principal and interest?
Yes, it is. Yes, it is. And so this shows you that sort of the cash flow position of the consumer has improved enormously. I was in Washington yesterday talking to some folks from the administration, and they are putting together a new housing proposal, which sounds like it has to be passed by Congress, so it may not have to be something that could happen this year. But it sounds like it may have some promise to actually improve this even further. And it's a new mortgage refinancing program that will allow even underwater mortgage holders to refinance, even if they're up to 140% underwater. The folks that we talked to seemed fairly optimistic and said that there's some hope for bipartisan effort on this. I'm a little cynical given where we are in the election cycle, but I think it would be something that would help enormously.
And who takes the loss?
Well, the banks.
The banks.
Yeah. Well, let's just say that well, it's not just the banks, but it's spread. And these are loans that the banks probably are not going to get anything back on to begin with. Some of them, right? And then you will. I mean, I'm skeptical too, but they're trying their housing programs, and housing's a big problem. Everything they've tried to do has been very incremental and not so successful. So it's just something to pay attention to. You'll be hearing about it, I think, in the future. Another thing we hear about, and I think is a strength and a support in the economy, is on page 10, and it's the corporate sector. So the U.S., the household sector is in a more liquid position, as I just showed you, but the corporate sector is pretty darn healthy. So these lines, what they're showing you, the blue line is cash on balance sheet. These are non-financial corporations. Cash on balance sheet is a percentage of financial assets, and the green line just shows you as percentage of GDP. Historic levels of cash on the balance sheet. Now, how come? Well, a couple of years ago, we started ratcheting this number up, and I think it was because companies were afraid they weren't going to get the cash that they needed from their regular sources of finance. I don't think that's the case today. And increasingly, I think these levels of cash will be deployed in economically constructive ways, in hiring and investing, paying dividends, M&A, and we're seeing that already. But I think this is a very positive support for economic growth.
So can I also ask Marianne a question? We've heard from our high yield managers that the so-called wall maturity has been pushed out. There's been lots of issuance over the last few weeks, in certainly some of the large names and also some of the secondary names. So does that mean, as our managers are telling us, that the expected default rate should continue to be very low, even if business does not go up to plan? They are pushing out the maturities, and they do have their capacity to continue doing business.
I would agree with that. I would agree with that. I wish the federal government would do the same. But they are taking advantage of historically low interest rates. Corporate sector is in great shape. The cash on the balance sheet, the profits have been very good. And one of the reasons that employment has been disappointing is that U.S. companies are very productive, and they're finding ways to produce at lower costs continually, and that's just the world we live in. But I think the corporate sector is in fine shape going forward. Also, I would say that another misperception is that the banks aren't lending. The banks aren't making mortgage loans to a large degree, or commercial real estate loans, but they are lending. And this chart just looks at short-term business finance, looks at commercial bank business loans, and it looks at non-financial commercial paper. And you can see we had a huge contraction, but we're growing again. And I can show you a similar chart on consumer installment credit. Credit card lending is picking up. The credit card delinquencies have come way down. And there's been a tremendous amount of healing that I don't think gets recognition. And that's what gives me the confidence that we have a pretty firm base from which to grow. We may not be growing at great rates, but we're growing. If we look at employment on page 12, actually this is unemployment. What you're looking at here is filings for unemployment insurance. I am very encouraged by this chart because, we came down from the peaks that we had in the recession, but last year we kind of got stuck. We had come down a lot, and then we started to go sideways, and then we started to drift up a little bit. It feels like the layoff activity is genuinely diminishing, and I take comfort in that. And I think that this is the most important chart. If you looked at one chart every week, this would be the one.
And unlike the labor surveys, which are surveys, and then they always revise the numbers, these are actual real life
These
numbers.
are people going down the street and filing when they get laid off. Absolutely. So I'm going to show you one positive housing chart because they're hard to find. I can honestly say that I do think broadly that housing has bottomed, and I think that's in terms of activity, and I think it's also increasingly in terms of prices. Today we had the Case-Shiller House Price Index out, and there were a smattering of places where prices actually went up. And it's interesting because where they went up, where they're starting to go up, is where they actually went down the most. So I think that might be telling you something. And we are hearing that in places like Florida, for instance, that activity is picking up. But what you're looking at on page 13 is the dark line is the home builder survey. It's a monthly survey on home building activity. Their survey of traffic. And that's a great leading indicator of building permits, which is in itself a leading indicator of building. So what you're seeing is a very smart pickup in the last couple of months in this traffic index. And it's telling me that this spring that we're going to have some kind of increase or recovery in home construction. And I think we are. I mean, when you look at the level of inventory in new home construction, it's as close to zero as it could get. And increasingly, the supply, we do have excess supply of existing homes out there on the market, but increasingly, what's in that number is not as competitive with new home construction. And an economy where there's genuine improvement, I think that you should expect to see some recovery in the home construction area. And I've got that built into the forecast. As a matter of fact, I think it's the only sector of the economy that I actually have accelerating this year. Everything else is more steady. So I hope I'm right. Last couple points, and then we can open it up to any other questions you have. So this isn't an exhaustive list, but these are the big things that we have to focus on as it relates to the federal fiscal situation. What this table is on 14 is telling you all of the things that are going to happen automatically on December 31st unless somebody does something to prevent it. So the big deal, obviously, is the expiration of the Bush tax cuts. That's $255 billion if you look at them in the aggregate. The alternative minimum tax, every year, more and more middle-income people are pushed into that alternative minimum tax category. And so in order to prevent that from happening, we have to fix it every year, and it costs us about $40 billion a year. There's a tax increase for Medicare that goes into effect at the end of the year. There's a $109 billion across the board budget sequester that specifically comes from the failure of that super committee to come up with a fiscal deal last summer. And of course, there's the payroll tax cut that we just extended for workers of $112 billion. This is a lot of money. And $535 billion is 3.5% of GDP. And when you have an economy that's growing 2% real and maybe 4% nominal, this can't happen, or else you're in trouble. Yeah.
Sorry, excuse me, this is something basic, but how do expiration of tax cuts on top and then extension of a tax cut both amount to fiscal debt?
Well, the Bush tax cuts, I don't know why we still call them Bush tax cuts, but it's been gone for a long time. Tax rates automatically go up January 1 across the board. Individual income tax rates will go up automatically across the board because the tax cuts that George Bush originally put in place have been extended year after year after year through the Obama presidency. Individual income tax rates will automatically go back to what they were prior to the Bush tax cuts. And that's a significant tax increase. It's, as I show you, $255 billion on individual income taxes alone. There are other elements of that, there are other elements including dividend taxes and capital gains taxes and that would also revert. But these are the big budget items that would potentially hurt the economy if they were allowed. Now, the payroll tax cut was something that we recently did to help this economy get going. And basically, what that is it's the percentage of your that's taken out of your paycheck to pay for Social Security. So we reduced temporarily what you were contributing into your Social Security taxes. That's what the payroll tax cut refers to. So that's another 112. So the point is that this isn't going to happen. I mean, I can't imagine that this would happen. But I think that we're going to be fighting about it. And I think there's going to be a lot of there's going to be a few games of chicken, and we're going to. Towards the end of the year, the markets might get kind of nervous about this. So,
well, how do you think we reduce the deficit if we don't have any money to reduce it with?
Well, I think we have to be judicious in terms of the time frame, right? First of all, I've always said that it seems unrealistic to me to think that we can have a grand budget deal in an election year. I think we will deal with the budget we'll have to deal with it towards the end of this year to deal with these things, but I think our best shot at having a long-range plan is next year. Now, that in turn is obviously highly dependent on who wins the White House and the composition of Congress. If you were to ask, what do you think is the best combination to actually have something done, it would probably be Obama in the White House and a Republican Congress and a very narrowly constructed Senate, which is probably a given. And it's going to take both sides.
That's what we have now. Nothing's happening.
Well, it's an election year. I was in Washington yesterday.
Last year, the year before.
Look, everybody knows that it's funny, I sat through a bunch of meetings listening to White House staffer, to House staffers on the Republican side yesterday, and then Democratic staffers, and to a man, the Republicans are saying no new revenue, no new revenue. It's totally unrealistic. There is somewhere to meet in the middle, but you can't do it in an election year. And I think you can do it under the guise of perhaps a broad-based tax reform, where it's kind of crazy because it gets down to lingo and budget language, semantics. You can't raise tax rates, but you can reduce tax expenditures. It drives me crazy because it's the same thing. We're done.
Thank you so much, Marianne.
You're welcome.
We appreciate this. Is fascinating.
Hopefully
We wish
I've
we
got
could
on
spend
too
all day. But we have run
Thanks for
out of time.
having me.
Thank you.
I hope New York is recovering nicely and tourism is up and looks pretty.
You open an office.
Come visit me.
We really appreciate your business, and thanks for having us on.
Thank you. No, that's not mine.
The reason council pays nobody's paid the mortgage anymore. Everybody who left the house and now pays so doesn't count.
No, what we're going to do is
Well, you know,
Okay. Pardon? He's gone.
I'm sure he'll be fine.
Well, I hope he comes down. Martin, you can go ahead and get started.
Okay, so next item on the agenda is the quarterly report for December. We do have extra copies here. Sorry. We do have extra copies here of the December quarterly report, so if anyone needs them, please either feel free to come over or we'll pass them through. Sounds like we have a customer. That's okay.
Trust me on that. So you'll recall back in September, it was a very volatile time, dreadful for the capital markets on the basis of risky assets, and you saw the negative numbers. In the December quarter, the markets definitely calmed down, and we'll go through some slides later that illustrate that. But risk was back on, and in the quarter, the Russell 3000 gained 12%. Non-U.S. equities were a little bit more modest, but they were still up. For the Russell 3000 for the year, that 12% gain put it in slightly positive territory. Depending on what index you're looking at, it was slightly negative, slightly positive, or roughly flat. High-yield bonds, which are also correlated to risky assets, had a very good quarter at 6.1%. So in short, risk came back into the market and helped the performance of those assets as well as the retirement system. The Core Plus 5, which had done very, very well, specifically the Treasury sector, came back to earth. And while it was up marginally at 1%, and certainly very well, 9.4% for the year, that's a good sign when the Core Plus 5 came back, because it meant that money flows and investors were more interested in taking risk. Going to page 7, you'll see some new colors and new bars. What we're doing here is, and we'll have this evolving over time over the next few months and quarters as we move from the old policy to the new policy. What we show in red is what the old policy index is. What we show in yellow is the adjusted new policy. So it's the new policy taking into account the parking places that were adopted previously. While we were behind the benchmarks, the returns were very strong, and I'll show you what that means versus all the other large pension funds. But the returns for the quarter, very strong positive at 549. You'll see the fiscal year to date in blue, minus 458. While I'll fast forward, and we'll go through this in a moment, pretty much as of yesterday, we figured out the number. You're definitely back into positive territory, and we'll talk about that a little bit more. January was a good month. February was a good month to date. The longer-term numbers are also positive. So the bad times in 08, while they hurt the 5-year number, we're back into positive territory. And we will have this, some more charts that we'll show in this book, which we'll go through in a couple of minutes, that will detail a little bit more, and we're evolving some new charts that will help explain in numbers and in words how we're moving from the old policy to the new policy and where we are.
Just as a quick high level, what is the explanation for the 1.5% per year underperformance for the last 3 years relative to policy?
In some cases, it's private equity. In some cases, it's we were overweight fixed income versus equity, and equity did well in the recovery. So that is primarily what it comes down to.
So you think it's mostly an asset allocation drift question relative to...
No, I think it's more of some managers were underperforming, and we'll go through that actually in a couple of pages.
Okay, thank you.
The good news is a lot of those managers, SEMA, as you know, has reallocated to more productive equity areas. We have a few more pages here. The first page with the pie charts shows simply the pie charts. Pie charts on all 3 pages are the same. It's where we are invested. The assets were $39.4 billion as of December 31st. That doesn't change. The pie chart doesn't change. We are where we are. What changes is on the bottom part of all 3 pages. So that on page 8, we show the old policy. So you'll, just as an example, on the very left, you see we were underweight that's the green bar all the way on the left, to U.S. equity. If you turn the page, this is the unadjusted new policy. So we were overweight to the new policy, and that's because we reduced our exposure to U.S. equity. And then we have another page, which is a new page. This is the adjusted new policy, and so things are a little bit more moderated. So, for instance, the underweight in hedge funds that you see on page 9, which is in blue, of minus 2.9%. The underweight in opportunistic fixed income. The underweight in areas that we're going to be investing have parking places, and that money is typically in U.S. equity in high yield tips and core plus 5. And so this page shows where that is. One thing that doesn't change is the cash. And I can tell you that the cash was, and we've been talking about that, Larry's been talking about that over the last few months. The cash, as of the end of December 31st, was 4.7%. Certainly in an up market, that is a drag to performance. We have been putting more money to work. As of the end of February, I believe we'd be in the 2s. And by early spring, we expect that cash to be down to effectively zero, marginal cash balances to take care of benefits. And in fact, we'll be paying benefits out of the asset allocation to help do the rebalancing in that case. So where we are today, that cash is in the 2s and further going down, mostly going to hedge funds, non-U.S. equity, and opportunistic fixed income, which is part of what the asset allocation was trying to get to.
And as that happens, Martin, because we're looking at the adjusted new policy weights.
The adjusted new policy will now drift closer to the new policy.
The underweight that shows now to core plus 5 will become less of an underweight because that's being moved into the other area.
All of the differences in the new on page 9 and page 10 will start to converge.
Right.
And we will have, again, as I said, more detailed charts in the future on a monthly basis as well as a quarterly basis that show that to you in words and in numbers. What I do want to point out to you is on page, a couple of numbers, how you did versus your peers on page 15. For the quarter, you were in the 19th percentile. While we did underperform, that's top quartile. The benchmark itself was right on top. The good news is the one, and again, I'm looking here in the middle of the page, the annualized numbers, the 1 year, 3 year, 4 year, 5 year, were all either top half, or in the case of 4 year and 5 years, right at the top quartile. So that's the neighborhood that you want to be in. I'm going to turn it over, unless you have further questions, to Seema.
Martin, I have a quick question.
Sure.
So on page 14, where you talk about the attribution to return,
Yeah.
where is the allocation effect? This is the management
This
effect?
is the management effect.
Where's
The allocation effect is shown on the previous pages, but it's not by asset class.
Is that available, or is that just not something?
We can certainly get that, of course. We can get that for you.
Okay.
And just so the board is reminded, the board has asked us now on an every 6-month basis to come in and make sort of an expanded investment performance report that we put together. We'll be doing that next month for December 31st quarter. The attribution that you talked about, Jan, to be a major part of that. Again, there will be some rounding or minor differences between what Dan puts together and what we put together, just based upon, but we'll get to exactly the issue. I think that's
Okay,
Yeah.
thanks.
So certainly we can get that for you.
Great.
I'm sorry, Larry. Yes.
Your return on 15, that's providing all tax pension.
No. Okay. The chart on 15 shows NYCERS versus other large public funds defined as greater than $10 billion. So no, it's not combined. It's just NYCERS.
Okay, so if you turn to page 19, we'll start with domestic equities, and here it's just a broad picture across large cap, mid cap, small cap, emerging managers and the like. So overall, if you just look at the quarter, NYCERS was basically in line with the benchmark, the Russell 3000, a little bit ahead. If you look at longer periods, again, I'd say roughly in line with the benchmark. The next page, though, will give some more detail on how those numbers came together. So if you turn to page 20, I'll just point you to a couple columns. You see the index return, the actual return, and then the difference columns. And you'll see also in the first row there, small cap active being underweight by a bit over 200 basis points. We will be addressing that both in this meeting and then in the next couple months as we think about small cap active. But you can see there in the difference column for small cap active, NYCERS is a bit behind the benchmark there. Most of that had come from Daruma, which is one of your managers. Although the quarter wasn't as strong over longer periods of time, they've done quite well for you. And then I'll just point out another number in that column, which is the last number there under U.S. activists and environmental. Stronger performance coming from there, and that would have included breeding, which, as you know, though, we're moving our way slowly out of. If you turn to page 27, we will go to the international allocation. And again, we've broken it up similarly as to U.S. equities. We've got EFA, cross growth value, core, and passive. And then we've got non-U.S. activists, non-U.S. environmental, and then active and passive emerging markets. And again, these three columns, index return, actual return, and the difference. I'll just point to a couple highlights. Under EFA core, which is 3 rows down, NYCERS outperformed by over 200 basis points. Most of that coming from Philadelphia, which is one of your managers there. But if you notice, growth, value, and core in EFA actually all outperformed, which is a good result. And then if you scroll down a little bit more to the non-U.S. environmental, underperforming by a little bit. That's both generation and FNC being behind, both peer managers in that area. And then in active emerging markets, basically had an offset between DFA slightly underperforming and Acadian slightly outperforming, and that's how you get to that number there. If you then turn to page 28, which is EFA, and again, as I mentioned, you see in the trailing 3 months in the quarter, the purple bar is the total EFA markets for NYCERS, and the yellow bar being the index. And you can see good outperformance there. And again, that was both, actually all three, core, value, and growth doing well in the quarter. And if you look at over longer periods of time, both in the fiscal year to date and the trailing 12 months, roughly in line with the benchmark. Next, on page 33, will be the emerging markets breakout. And it's against the custom index. NYCERS. You can see both in the quarter, the fiscal year to date, and the trailing 12 months, roughly in line with the benchmark. And now I'll turn it back to Martin.
Right. So thank you, Seema. If you turn to page 38, we have a summary of where the assets were in the fixed income world, and that represented $12.6 billion, or 32% of the fund, as of December 31st. And a little bit more than half was in the investment grade structures program. That program is further broken down on the following page, on page 39. $6.3 billion, or 16% of the fund, was invested here. We were underweight treasuries and overweight the spread sector. In this particular case, as my opening remarks pointed out, risk came back into the market, and so while treasuries did return a positive number, the best performing sector was the investment grade credit sector as investors looked for corporate credit. So we were overweight there. We earned an even 2% beating the benchmark. Of the three sectors, two of the three beat the benchmark, and mortgages were just 4 or 5 basis points behind the benchmark. Putting it all together on the following page, the 4 plus 5 returned 1.41%. Given the yield of that, it's mostly due to spread compression and demand for treasuries in the beginning of the quarter. That was ahead of the benchmark by 8 basis points. Fiscal year to date was behind the benchmark, but returned 542. The yearly result, or the full year for 2011 was 885 behind the benchmark of 940, and the 3-year number of 931 was ahead of the benchmark, returning 931. Obviously, that is partially due to the risk on, risk off. Whenever risk is off, this is where the money flows into investment grade, and specifically into the Treasury and agency mortgages. TIPS are shown on the next page, on page 41, and it had a positive return of 280, slightly ahead of the benchmark, and for the fiscal year and trailing 12 months, also positive numbers. Last year returned 1350, just behind the benchmark, and since inception returning 681. TIPS are slightly different, of course, from regular nominal treasuries in that you get paid for inflation. Inflation, as we'll see later, has been running in the 3s, which is a little bit above what is priced into TIPS, and so you get a little bit kick in the return. And of course, if there's unexpected inflation going forward, this is where the portfolio would benefit, whereas unexpected inflation generally hurts other financial assets. High yields on page 42. As you know, we've been talking about every quarter and every month. High yield's been a hot place, with the exception of just a few quarters or a few months over the past few years. It was a strong quarter, returning 552, though that was behind the benchmark. The year was 573, so as you can see, the return came from effectively the last quarter. It was flat before then. And the fiscal year to date right now is roughly flat. The 3-year number compares very favorably, in fact better than the equity market, returning 922, roughly flat with the benchmark. As you know, we're doing a search on this, and if there are any questions on that, we can talk about it in the executive session. But we are going to be bringing to the board recommendations on that very, very soon. Convertible bonds are on page 43. I know it comes up why are convertible bonds underperforming. So what we did was, as you see, the yellow shows the benchmark, the Bank of America Merrill Lynch Convertibles Index, which is the All Convertibles Index. There's lots of sub-indexes. And the reason I mention the sub-indexes is because each of the 3 managers has a separate benchmark because of their styles and what they invest in, the delta, the sensitivity to equities. So you have bond-sensitive managers, equity-sensitive managers, and an investment-grade manager. The quarter is perfectly illustrating what we've been describing over the past few years. If you look versus the overall benchmark, we were behind by 59 basis points. The return of 363 was behind the benchmark. But when you look at each of the individual managers, we were ahead. So the managers did well versus their benchmarks, and we're ahead, in fact, by 91 basis points combined, but we're behind. As we've been saying, in a flat to slightly up market, the managers should be okay versus the benchmark. In a roaring bull market, they'll trail the benchmark. In a down market to flat market, they'll be ahead. And this chart actually shows that for the quarter, the fiscal year to date, as well as the other periods going out to 3 years. And this is simply because convertible bonds is a fairly small universe. Each of the managers has different mandates, and the benchmark as a whole, as we've seen and as we described when we started the program, is simply, there is no perfect benchmark for this program, so we want to have different points to show you to compare. The next few pages show developing and emerging markets, and those programs are doing okay. Certainly the emerging manager program is doing okay on page 45. Opportunistic fixed income, you'll see by its absence, is not here. The reason for that is we're revising the page, and it didn't meet the time frame for publication of this, although we will be talking about it in here in just a few moments. So coming up, we'll talk about why it's not here, what we're going to be showing to you in the future, and we do have the numbers in this book here. Unless there are other questions, Kathy's going to talk about ETI.
Good morning. Your ETI portfolio is a steady performer and is outperformed for the quarter, both its benchmarks, and while it lagged behind for 12 months, it did outperform both benchmarks for all the longer periods, which is what we expect and plan for in this portfolio. As always, in your large booklet, there is on page 9, it lays out where your investments have been made in New York City. You invested in an additional 312 units of housing in the last quarter, and the AFL-CIO Housing Investment Trust put another $12.5 million into workforce housing just in the last quarter. If there are any questions? Thank you.
Hi, we'll continue with the highlights of the real estate portfolio for the third quarter. And I'm working from the large board book on page 18. The market value of the real estate that we have in the ground right now is about $1.4 billion. We have about $500 million that is unfunded at this point, so our total exposure is about $1.9 billion. In terms of performance, the NYCERS portfolio posted a quarterly return of 2.3%, which was about a point under the real estate benchmark, the Odyssey net, at 3.3%. And if you look down at the bottom, you'll see a graphical depiction of the portfolio in the near term and over the length of the program. In terms of kind of digging into the quarterly performance, we talked about the fact that there is a keen interest among investors for core assets, and those managers, of which you have about 11 investments in the core space, all kind of acknowledged a growth in income of about 1% and maybe about 1 to 2% in appreciation, given the high interest, as I mentioned, by investors. However, when you look to your non-core managers, which are about 25 investments, given the volatility that we all kind of referred to that happened in the third quarter, these non-core managers took very conservative views relative to marking their portfolios. So it kind of dragged the overall performance for the real estate program for that particular quarter. I'm just going to move on to page 20, which is a snapshot of the portfolio. And as you know, there is a reporting lag, so this reflects activity for third quarter 2011. So I'm just going to kind of skip through it, actually. So we have a 6% allocation overall by the NYCERS Board to real estate, and that would translate into a $2.2 billion allocation. The following section talks about the style that has been approved through the IPS, and both the core plus, and the non-core bands have permitted levels of 40 through 60%. And if you look at the next section, which has funded market value and committed statistics above it, it'll show you where we actually are. We are in compliance. We're about 46% core plus, 54% non-core. That non-core includes the opportunistic managers. The non-core also includes the subset of emerging managers. So as we stood at third quarter 2011, we were 3.8% funded, about 5% committed. There was also some investment activity during the third quarter. As been reported, fundraising has been really, really tough for managers out there today. And in terms of what real estate fund managers have been able to do for 2011, it was about $47 billion, close to what they did in 2010, slowly inching up, but certainly a lot more difficult than they had expected. Institutional investors, just like the city, have been extremely selective in who gets the next dollar, and as you know, we here at NYCERS, we committed $70 million to Taconic and $70 million to Carlisle 6, and we closed both of those deals in the third quarter. And just to also give you an update as to the deal that we brought last meeting on Blackstone 7, we committed $170 million. That deal is also now closed, and across the system, I told you I would update you, but across the system, we did make that $300 million mark as we presented last month. So just to kind of give you an update. Our report card is on page 21. In terms of the benchmark, we're slightly under the benchmark by about 40 basis points, and this covers a 5-year period. In all other respects, we are operating the program within the approved parameters. So does anyone have any questions? And we'll talk further about managers later on.
Okay, and with that, we're going to touch a little bit on private equity, which is page 27 in the big book. Again, I'm going to be relatively brief because in the executive session we have a lot more to talk about within private equity. So where we are today as of September 30th, the system is committed to 91 managers to 132 funds, up from 88 managers and 128 funds in the previous quarter. Today, total exposure for private equity is roughly $5.5 billion. That includes, call it roughly $3.7 billion of contributed capital, and there's a little over $2 billion in unfunded. Returns as of the third quarter, 1.24x and 8% net return. If you go to the next page, page 28, you'll see how the portfolio performance looks versus the benchmarks. Again, NYCERS portfolio 8%. The Russell 3000 plus 500, which is the policy benchmark, is 6.9%. So there's outperformance versus the policy benchmark. As we've all talked about in the previous meetings, another way to look at this, which again is in the policy benchmark, is to look at the private equity benchmarks. The two we have in here are the median IRRs and the upper quartile IRR. Again, median is the middle, so that's 2.4%, so significant outperformance there. If we look at top quartile, which we think is a better, a better market indicator, underperformance by NYCERS again was at 8%. The Thompson top quartile was at 10.8. Going back to the policy benchmark where we are, so if you look at the middle of the page, buyout, today market value is at 71.5% in buyout. Policy is 60 to 80%, so right in line with that. Venture capital today, again, we've talked about this before, where we're not making recommendations on the venture side. We believe venture now should be more focused on growth. Policy benchmarks there in the 10 to 15% range, again in line with policy at 10.8. The last bucket, which is the catch-all other bucket, which has got a policy benchmark in the 15 to 20% range, that again is in line with distressed, mezzanine, secondary, and co-investment. One of the things that we'll notice later in the presentation is that due to some negative trends in the public equity markets, that has brought down the returns in the private equity markets. Policy target is 7% for private equity. To date, the private equity portfolio is a little over 8%. Again, in the executive session, we'll talk a little bit about the rebalancing and the restructuring of the portfolio. Again, just to wrap this up, last couple things I would mention is if you go to page 36 and 37, we've talked about in some of the previous quarters, which is contributions versus distributions, is on the bottom of page 36. One thing to note, if you look at the third quarter, significant amount of contributions versus distributions. Again, that was more of a market trend, not as much as a NYCERS trend. The last page, which is page 37, you'll see a list of 10 funds. These 10 funds represent roughly half of the downturn in the returns from the second quarter to the third quarter. There is one trend that you'll note in here. If you just look at line number 3 and line number 9, those are both secondary funds, which is where you've seen actually an uptick in the overall valuation. Again, in the executive session, we'll talk a little bit more about that as well. And with that, if there are any questions, that is private equity.
So I think you're back to me. This is item 3, starting on page 48. We do have extra copies, so it's more readable in color. We can pass them on down on this side, and we can pass them on down on this side. So if you have a copy, please pass it down, because we may not have enough copies. So.
Mark, just in terms of the month's performance, much of that was in the quarterly.
Right, I was just about to get that. Because of the timing of when we presented the quarterly report, which is February, it coincides. Normally what happens is the quarterly, then we do the next month. In this case, the quarterly is the same numbers here. So I'm not going to repeat myself, except to go into a couple of key points that I wanted to raise. I'm also not going to go into every economic slide, because part of why we had Wellington come in to talk about their economic outlook, but I do want to bring up a couple of points. So, everyone have a copy of this book? So in the book on page 6, Wellington mentioned weekly unemployment claims, and it's a very clear trend where the last unemployment result was in the mid 300,000 per week range. While that sounds like a lot, economists look at 400,000 as being recessionary, over 400,000 being near recessionary. We're clearly below that, and the trend is our friend at this point. So that's certainly good news. The unemployment rate on the next page is down to 8.3%. You heard me ask Marianne from Wellington, is that because of the lack of participation? The way this number is calculated, it looks at the total employment participation rate, and when you have discouraged workers, they no longer count towards, even though they are people who are of working age, who could be working if they're discouraged enough. The way the survey works, and this is based on a survey, the unemployment number can go down because of discouraged workers, because the overall participation rate goes down. Meaning when you take into account all workers, whether they're discouraged workers, part-time workers, underemployed workers, and truly unemployed workers, the number is in the mid-teens. However, the number has been coming down. There's no arguing that. So that's good. And that was on page 7. If you turn to page 13, you'll see that new housing starts This has been a dreadful chart since the downturn and financial crisis. It's been bumping along the bottom at post-World War II lows, but there is a slight increase. This is all obviously due to income, unemployment, and inventory, and foreclosures. So new housing starts will start to pick up when there's more demand, when the economy starts expanding again, and ultimately when the amount of houses available, existing home sales, which is the chart before, people say you know what, that's outdated. We want something new. And as prices come down, that becomes more affordable, and certainly mortgage rates are more affordable. The question is whether you can get the mortgage. U.S. auto sales. This is a very interesting chart on page 15. The peak of the auto sales, obviously before the financial crisis, was at a 16, 17 million per year run rate. And you'll see we're now up to 14 million. That's a very good number. Part of that reason, and by the way, you see the spike in the middle of 2009, that was the cash for clunkers. So it effectively took demand that was going to come from the next few months and into that June month. But when you smooth it out, the trend looks very good. Part of that is obsolescence of old cars. People have been holding on to their cars longer because of the higher unemployment rate and uncertainty. But over a certain period of years, ultimately you need to get that car. And that's a very good sign. And then when you take into account the lower unemployment rate and payrolls, and you see slight improvements there, the 14 million per year run rate is a very good sign, and certainly the trend is good. Inflation is on page 17. The number is now 2.9%, roughly 3%. This is a number that you really need to keep your eye on due to the potential inflationary aspects of what the Fed is doing with their policies. But inflation does seem to be under control, and by the way, the Fed wants inflation to go higher. As far as the markets go, starting on page, let's look at page 20, the dollar exchange rate versus the euro. There's been lots and lots of problems with the euro, and yet the euro, while it did for a cup of coffee go below 130, is now up above 130, which I think more says to the weakness of the dollar than to the strength of the euro necessarily. That, of course, is arguable. The chart that we took out that we put back in, the reason we took it out is on the next page on page 21, 3-month LIBOR rates. We took it out because it was kind of a flat line, wasn't really giving much information. And part of this is scale. Prior to 2009 and 08 and 07, LIBOR was in the 4s and 5s, and now LIBOR is effectively 0. But you'll notice that 9, 10, and 11 pretty much looks like a flat line, and 3-month LIBOR was about 25 to 27 basis points. But as the euro crisis intensified over the summer, LIBOR actually doubled to about 52 basis points. The reason we have the chart here, and it's important, is actually it's gone down, which means that in addition to some of the charts we're going to show you, the programs that the ECB has put in has helped banks lend to other banks. Next page is the volatility index, the VIX, page 22. This is a very important chart. We were flirting with the 40s, and if you look across, and certainly historically, when you hit about a 40 level, and the VIX measures the amount of investors that are concerned with their portfolio and looking to buy puts to protect their portfolio. It's a ratio of puts to calls. 40 has historically been the time, you know what, there's a lot of volatility in the market. Markets now may be a time to buy. And with the exception of 08 where it spiked at 80, 40 has been good. Where we are now is at 18, historically is a normal level. But recently it's a very low level, and that also explains that investors, which is what the Fed wants, by keeping rates at 0, pushing them into risky assets, combined with the perception that the European authorities are beginning to get a handle on their issues. The VIX has come down, so investors are less concerned about protecting their portfolio, more interested in taking risk and earning a higher rate of return rather than keeping their money under the mattress. The next page shows the yield curves on page 23, and the Fed is doing their job in lowering yields across the curve, so that investors have no choice but to move into riskier assets. One of the negative sides about having a flatter yield curve, when I say flatter, meaning long-term rates coming down as well as to where short-term rates are, is that banks make more money and will be healthier with a steeper yield curve. The yield curve right now historically is still steep, just not as steep as it was during the record steepness over the 08-09 period. An important chart on page 25 shows how investment grade and high yield spreads look. High yield spreads as of the date of this book printing was at 607 basis points above treasuries, basically yielding around 8% or so. Investment grade is at 176. The 607 since September, you'll see that interim high there. That was in September when high yield yields were roughly about 10%, and we did start putting money back into high yield right around that time when we saw that yields made more sense. So that is good news. Investors are investing there. I also, you may have noticed, I asked Marianne from Wellington, there's been tremendous new issues, and it's not just new issues of every little company, but it's the largest companies out there. The largest company in our index, in our high yield index, is CIT, which is a financial company, and a lot of our managers are interested in CIT. It's, like I said, the largest out there, and there's been tens of billions of dollars in overall issuance, including a lot from the largest issuers that institutional investors are interested in. So supply is there, and the managers are able to put the money that we've given them to work. We have a few pages showing price to earnings ratios starting on page 28 and page 29. Effectively what this is saying is that in the U.S., large cap is, on a historical basis, relatively attractively priced, unless you assume that the earnings, the E part, is not realistic. But the prices are fair, if not cheap. As you get into small cap and mid cap, obviously there's more risk just because the companies are smaller, and there's also higher growth potentials in those, so PEs generally are higher. And lastly, for the returns, for at least the market charts on page 30, returns for the last year, and here this was printed through February 6th. This market continued going up after that, and we'll talk about that in a little moment. But the white line is U.S. equity measured by the Russell 3000. Green is developed markets, EFA. Red is emerging markets. And U.S. is clearly led. For the last year, it's in positive territory. And since this chart was printed, is even in more positive territory, where the developed markets, which are, of course, highly weighted towards Japan as well as developed Europe, were in negative territory. Emerging markets are positive and we'll show you in a few pages, have done very, very well recently. Pages 32 and 33 show where NYCERS is. 32 shows the one-year results as far as market values, and page 33 shows the last 10 years. As of December 31st, the market value was $39,430. I can give you a sneak peek. I did the calculation yesterday, and again, this is an estimate, not exact, but our estimate is that as of yesterday, or as of Friday, the market value was nearly $42 billion, or $41.9, meaning depending on where we end February, unless there's a significant downturn, we will be challenging the all-time high more recent vintage that you see there of the $42,359. So we're in the $42 billion range right now as we speak for NYCERS, even though as of December it was $39,430. The next three pages we went over in the previous chart, so I won't bore you with that. Page 36, we're in the process of improving. What we show here is where the assets are invested, the policy target, the adjusted policy target, and the rebalancing ranges. What we've done to improve this, and hopefully we get it to you next month, is to break it. Obviously, we'll need more pages unless you get the magnifying glass out because the words are so small. What we're going to do is show you what the parking places are that the board approved, show you the math as well as the words. Right now, the words are on the bottom in small print, and sometimes hard to comprehend exactly how much we're putting into U.S. equity, how much we're putting into high yield, while you can see the numbers. But we'll color code it, and we'll have it for you in numbers as well as words for better understanding. And we'll do that going forward and obviously continue to improve. December numbers are on page 37. I want to talk about January numbers on page 38. This is what you're going to see next month. If you take a look at the page on the top left, that's where the market returns were for the 1 month for U.S., and the Russell 3000 returned 5.05. So while fiscal year to date, as of December 31st, you were down 4.5%, you were very close to break even, or zero. And because while we don't show February here, I did tell you that February, we estimate as of Friday, we're up to nearly 42 billion, 41.9. I also estimate as far as returns go, you're in the 2.5% range. So Bob North, we're getting there. Where we got the returns from in December on page 39, U.S. equity in green, again, all the way on the left, we earned 33 basis points. Most of it came from domestic, so it came from the Core Plus 5, high yield, as well as U.S. equity. Non-U.S. equity hurt because there was still concern going on in the developed markets there. We summarized on page 40 by asset class. I mentioned to you we did not show opportunistic fixed income in the larger book, and that's because we wanted to make sure the numbers are correct. I'd rather talk about specific things if you have any questions about specifics in the executive session, because there are certain managers that we'll get into. But the issue here is the same thing that Barry faces in private equity and that Yvonne faces in real estate, which is the time-weighted rate of return versus the IRRs. Ultimately, dollars in, dollars out comes out to be the same thing. But for fund by fund, it comes out to be different. I'll give you an example. And then we can talk about it if you wish in executive session. Using an exaggerated example. A fund that made us money over the last 5 years. Let's say we put in $50 million and we took out $100 million. Doubled our money, took 5 years, let's say we averaged 15%. If we had 10 cents left in that fund, it's winding down, and for whatever reason the manager wrote down that 10 cents to 5 cents, that's a 50% negative return using time-weighted rates of return. That 50% negative rate of return impacts the returns going out to inception. However, we doubled our money over time, so it's not taking into account the money that we put in and took out, and that's the IRRs. So that's a chart that we're going to develop with you. Now, ultimately, as you get down to the bottom line of the retirement system, it all comes out to the same number. But for each individual manager, it is not necessarily accurate, and that's why you see with private equity and real estate, they have a separate number aside from this to show you what the IRR looks like versus the time-weighted rate of return. In the executive session, I can give you specific examples of that. And that's why we start out the numbers later on for opportunistic, which we will unstar when we have the new report for you. And we're working on, we just missed the deadline for the printing of this book. Seema, do you have any comments about equity managers?
No.
So, questions from the board?
So, if we have no questions on the performance reports, thank you very much. That concludes the public session. Are there any other agenda items for public session?
It does include the public session.
So do I have a motion to exit public session and enter executive session? Do we have a second? Any discussion? All in favor? Any opposed? All right, thank you. We are in executive session.